So maybe your company has finally achieved that place where you're ready to raise money from a venture capitalist, or at least you think you are. What does that even mean? What's the process? What should you expect? Well, those are the exact questions that we're going to dive into in this video. We're going to talk about what is venture capital, who is venture capital really right for. We're going to talk through the general process that most companies go through when they raise venture capital, what to expect, and some of the pros and cons of hopping on the venture capital bandwagon. All right, let's dive in. So first of all, what is venture capital? Venture capital is a source of funding for high growth startups. When I say that, what I mean is you have venture capitalists whose job is to invest other people's money into companies that are super risky but have the potential of becoming really, really big businesses. The thing with venture capital is that as a VC, you're looking for companies that have the potential to become really big, right? The next Tesla, the next Google, the next Facebook, whatever it might be. You're looking for those world-changing businesses. Or at the very least, you're looking for companies that can reach hundreds or billions of dollars in value in a relatively short time period. At the end of the day, these investments tend to be really risky because what's the likelihood that the next company is going to be an Apple or a Tesla or a Facebook or an Airbnb, right? Those businesses are really rare to grow and get that big, but the payoffs can be phenomenal. For example, Lance Armstrong. You know that guy that did all the doping and got in a lot of big trouble and really trashed his brand? Well, you may not have known that he became a billionaire because he was able to invest in the very, very early stages of Uber. And his $100,000 investment later became worth over $1 billion, right? And so even though these businesses are super risky and most go out of business, there is the potential for massive home run returns. But what does that mean? That means that venture capitalists are looking for businesses that are growing really, really fast, that have a competitive edge that allows them to kind of dominate a market, right? And that have the ability to do it in a relatively short time frame, right? Because we don't have 50 years to wait for the next IBM to grow and get that big. We only have, in most cases, as a venture capital fund, roughly 10 years. 7 to 10 years between the time we need to invest and the time we need to exit the business. So with all those things in mind, if you feel like you're still a company that should raise venture capital because you are growing super fast and you think with some additional capital you could grow even faster, then follow along with me and we'll walk through the process of raising money from venture capitalists. Okay, so the first thing you need to do is you need to pitch to venture capitalists. So here's my top tip for pitching to venture capitalists. You should be reaching out to them any which way you can through warm intros. Those are the best because a venture capitalist gets hit with deals all the time and they need a quick and easy way to surface the most interesting opportunities. And the way that most VCs do that is through warm intros, where the VC can leverage kind of the expertise and the gatekeeping of the person that's making the introduction to give them information on whether or not that company is worth meeting with. So some potential avenues of warm intros. You could talk to other entrepreneurs in the venture capital fund's portfolio. Those can be super valuable. You can talk to investors in venture funds and get intros from them. Those can be really valuable. You can get other VCs that have invested in your company or that you're meeting with to connect you to other VCs that they know and like. You could talk to lawyers and accountants. Oftentimes they'll make introductions as well. And if you absolutely have to, cold emails aren't the end of the world. But whatever it takes, get introductions to venture capitalists. One way to do that as well is before you're even in the fundraising process, go talk to some VCs and just say, hey, I would love some feedback on my pitch. One strategy that I've seen that I think works pretty well is you go to kind of like the top tier, your dream team VCs, and you ask them for feedback on your pitch, right? And a lot of VCs, they want to help, and so maybe they give you a few minutes and they give you some feedback. Then you say thank you, and you take that feedback, implement it, and you go meet with like the next tier down of venture capitalists. And you say, hey, I just got out of a meeting with so-and-so venture fund and told them about my company. Would you be interested in meeting? And I can tell you about what we're working on. Give them the pitch and then do that again with the next tier down. Hopefully, if you've got something really interesting, one of those two tiers down will become excited. And that brings you to bullet point number 2, which is diving into due diligence with the venture fund. After you give your first pitch, if a venture capitalist feels like it might fit within kind of their strike zone, they'll follow up and they'll ask for access to a data room and for some additional materials. So things that you should be prepared for in your data room, at a minimum, you should have your pitch deck, you should have your financial model, your cap table, your organization docs, particularly your company formation docs all should be in there. You may have additional files that talk about like user KPIs, an org chart, maybe some resumes of your management team. You might also include contracts with some of your customers. It should include kind of a wide range of due diligence items. Another thing that they might ask for is the ability to do some customer calls. So you should kind of have those teed up and ready to go as well. The venture capital fund will then kind of dig into those materials and then set up subsequent calls as they work through it to ask more questions and dive a little bit deeper. And over that period, what's going to happen is they either will become more excited or less excited with the deal, and your job as an entrepreneur is to kind of keep touch with them, keep the momentum going, and get them to a decision, either a yes or a no. If they really like the due diligence, then they'll issue you a term sheet. And look, there's a lot of schools of thought on whether or not the term sheet should be something that you lead with and say, hey, here's an example term sheet of something that we're hoping to do. In my opinion, usually it's better to let the investor make that first offer and then negotiate from there. Because oftentimes I've seen entrepreneurs that have gone out and said, hey, we're worth this much. And the venture capitalists immediately like lose interest in the deal because it's too expensive. And it actually ends up backfiring against them. So in my experience, the best way to get a really good valuation that gets people excited is to talk to lots of different venture capitalists and see if you can get multiple term sheets. Then you can play those term sheets off of each other before you find the one that really works for you. And at the end of the day, even one term sheet's better than nothing. So if all you can generate is one, that's fine. Do your best to negotiate as well as you can through it by leveraging a really good venture capital attorney. But, closing some capital is better than not closing any at all. Once you get the term sheet signed, you are engaged, but you are not married. So all you have is an agreement that the venture capitalist will invest a certain amount at a set valuation if the remaining due diligence goes well. Now, this remaining due diligence is confirmation due diligence or confirmatory due diligence, where they're going to check through and make sure there aren't any legal issues that they should be aware of. They'll continue to dig a little bit more on customer calls and reference calls on management and so forth. And as long as there's nothing glaring or some big red flag that pops up in that due diligence that they wouldn't have been able to foreseen otherwise, then they'll move towards a close. Moving towards a close, this all happens in conjunction with due diligence. And essentially what will be happening is you'll be working with their attorneys and your attorneys to hammer out the final definitive documents around the raise. You'll be negotiating things like liquidation preference and pro rata rights and information rights and major investor qualifications and levels. You'll be negotiating things like what are the responsibilities of the management, what kind of decisions need to be made with approval from the board, and which ones don't require approval from the board, and so on and so forth. And so these documents are fairly long and intensive, and the negotiation can take, you should expect the negotiations to take somewhere between 2 and 4 weeks to fully hammer out. Because pitching VCs, you'll want to try to create as much momentum as you can. So you want to spend some time teeing all those meetings up, have them all as close to each other as possible. I recommend to most entrepreneurs to plan on 6 months from start to finish. So if you're going to pitch VCs, you should plan on kind of 1 to 2 months of meeting with venture capitalists, pitching what you're doing, getting intros to others, and kind of building momentum there. Then those funds are going to start doing due diligence. And that can take kind of another 1 to 2 months. Although that can also be happening concurrently while you're pitching new investors. Over the course of those kind of 2 to 4 months, you'll finally get to a term sheet. So that happens typically in month 4. And then the remaining 2 months are all about confirmatory due diligence and getting to a close. Now, granted, there are in some cases where funds move incredibly fast. So in 2021, there was a lot of talk about Tiger Global, where Tiger Global would essentially call up an entrepreneur that they thought was interesting, and they would hear the pitch, and on that same call, they would say, we're in, tomorrow I'll send you a term sheet. And then they would send the term sheet, and 2 weeks later, they would actually wire money and close. And a lot of people were really skeptical of this. They were like, Tiger Global is just investing in some crazy ideas. They don't really do really good due diligence. What they didn't know is that Tiger Global was just front loading a lot of these things. So they work with Bain Consulting to map out, identify the top players in each space, do a bunch of due diligence. Then they would meet with the entrepreneur and they would already know quite a bit about the company. They would just need to confirm a few data points with the company. They already knew what they wanted to offer in terms of valuation and so forth. And their term sheets tended to be really clean, really easy, and very founder friendly. So there wasn't a lot of negotiation, and that allowed them to close their rounds very quickly. So it can happen that these things close in like 2 weeks, but in the current environment, that's not the case. Cash is king. If you've got a lot of cash in the bank, it puts you in a much better negotiating position. As we close, I just want to hit on like one of the big cons that a lot of entrepreneurs I don't think fully appreciate when it comes to raising venture capital. And that is, like I said at the very beginning, VCs are looking for companies that are going to be growing super fast and can achieve huge outcomes in a relatively short time period. And what that ultimately means is that once you take venture money, you kind of now need to be addicted or hooked to the venture capital drug. And what I mean by that is you're going to need to be raising more and more money to fuel faster and faster growth. Because at the end of the day, these VCs want to see the company grow, capture as much market share as possible, become a dominant player in their space with strong barriers of entry. And the only way to do that for the most part in today's day and age is to raise a lot of money, spend a lot of money, acquire a lot of the market, and establish yourself as a winner. That can be great because, life is short, and being able to get to a really great outcome in a relatively short time period can be awesome. The downside is you're going to give up a lot of control, you're going to give up a lot of equity in the company, and ultimately, it's going to be very stressful because you're going to have this pressure to keep performing. And if you don't perform, if you don't grow, it's going to be really hard to raise additional capital, and you could be put in a position where your company is burning so much money that if you don't raise more, you're going to go out of business, when you could have run it a little more less aggressively and not been in that situation. Maybe have even got your company to break even or profitability. But with all things, there are pros and cons. If you run your business too slow in certain markets and other companies are raising money faster than you, they can put you out of business just as easily. So definitely a lot of things to consider. At the end of the day, I love venture capital, but I know it's not for everybody. In fact, less than 3% of all startups raise venture capital, and it's probably even a smaller percentage that actually should. Anyways, join me for some of my other videos, like how to contact a venture capital firm, where we're going to talk about this first step on pitching VCs in more depth. Thanks.